All right, so it's the moment you've all been waiting for. I'm gonna make a crash course for you guys to understand what are options, how you guys can trade options, and then at the end of this video, we're gonna team it up with the Unusual Whales flow and how you guys can use the flow to trade options to make some profits. All right, so let's get right into it. Since I'm posting this on Twitter, I'm gonna be a little quick with it and we're gonna get right to it. All right, guys, so the options crash course, let's get to it. So what are options? Option contracts give you the right, but not the obligation to buy a stock at a specific price, which is your strike, on a specific time, which is your expiry. So this definition in itself confuses the hell out of everybody. So we're gonna scratch that, okay? Think of options as you are buying a contract saying that on a specific date, you're gonna purchase those shares of that stock at a specific price, okay? Now, you're holding onto this contract as a piece of paper. As the stock price goes up, the value of your contract also increases. So before you reach that date where you can actually purchase that stock, you can actually sell your contract, your paper, for profit. And the same thing goes with the put side. If you're buying a contract for puts, you're saying that you want to buy that stock after the price goes down. So if you're holding this contract and the price of the stock goes down and you're in a put contract, your contract in your hand is going to go up in value. Okay, so then you can sell it before the expiry and take your profits and run. Okay, that's, I think, where a little bit of a confusion comes into options and what the definition really means. Okay, think of it as a piece of paper. You're paying for a contract to buy a certain stock on a certain date at a certain price, and if that contract or if that stock price goes up in value, so does your contract, and therefore you can sell it to make your profits, which a lot of people actually do. Let's get right into it. Most platforms have this exact same layout. We have the puts usually on the right side and the calls on the left side. So the option strike is oftentimes in the middle. Okay, this tells you the stock price that you expect or want to buy the stock at, or the price that you think the stock is going to go towards. So this is called the strike. All right, the strike price is the price that the stock needs to be at in order for you to exercise the contract, in order for you to purchase those shares at the set time. Now, the expiry dates. Expiry dates oftentimes come right to the left of it, or if you're using the chains and all the dates, the weeklies, the monthlies, are lined up right here, and you can open the tabs to see what the actual strikes are for those dates. Okay, most platforms have a very similar look. This in particular is TD Thinkorswim. All right, so just to explain, the expiry is the date at which you think the stock will reach the desired price that you choose, aka your strike. If you are wrong, you will lose the money you paid for that contract, but if you are right and the stock reaches that price, then on that specific date, you have the ability, you have the right to exercise that contract and purchase those shares as you wanted based on that price. So a lot of people get confused here. You don't have to wait till expiry. You can sell your contracts for profits and be done with it. You don't have to exercise the contract. You don't have to buy the shares. If you're buying a call today and tomorrow the price goes up and your expiry is next week, you can sell that contract and take your profits and run. So this is the Greeks. This is also where another section where people start getting confused. What do the Greeks really mean? If you guys are day trading or if you're swing trading, what you really need to be worried about is one, the delta, and two, the theta. Delta is the amount your contract is going to increase per dollar move of the stock, of the set stock. So usually if the delta is 0.5, that means every time the stock moves up $1, your contract is going to go up by 0.5 in value. Theta is the change in value in regards to time. So let's say you bought a contract today, the theta is 0.5. That means every day going forward, your contract is going to lose 0.5 of its value. Okay, so delta, think of it as the dollar value you're going to increase in your contracts, and theta is time, so that's how much you're going to lose per day going forward. Gamma, vega, and rho, these are things you can research a little bit more after you start getting more into options and understand what it really is and how they really work. All right, so the sooner the expiry date, the riskier the trade. And that's why, we get into contracts. If we have weeklies, we try to take profits and we use them for day trades and we get out really quickly. If you're trying to swing trade options, then you're going to want to choose further out expiries who have better thetas. So theta is, again, the time decay or how much your contract loses in value per day going forward. All right, options premiums are to be multiplied by 100. So for example, what you see on the premium here, for example, on QS, it's 0.9. If you multiply that by 100, that's how much it's going to cost you to buy that options contract. Okay, so this would mean that you think QS will reach 32 by April 23rd, 2021. All right, why? We have April 23rd, 2021. This is the strike, and that's exactly what we're saying here. All right, so the cost is 90 cents times 100, which means $90 it would cost you to buy one contract. So that's how much money you got to put down to get that contract. So again, options move more volatile than stocks do. On an average, if you're day trading options, you want to have 20 to 30% stops in regards to your options. Now everyone's risk is different, but that's my rule of thumb, 20 to 30%. Meaning if you buy one contract at $1, your 20% stop would be 0.8. So if the contract drops in value towards 0.8, then you cut your losses and you get out, okay? The goal here again is to have a good risk to reward. So if you're gonna risk 20%, you wanna try to make 20 or even 40% on the upside. Now, what are option lottos? Everybody wants to know what this is. Everybody wants to trade Lotto Fridays. So we're gonna get right into it really quickly. So option lottos are pretty much options that expire the same day. They're considered lottos, okay? You get the contracts very cheap, but by the end of the day, if you are not right, you lose all your money, right? So that's why they're considered lottos. They're high risk, high reward plays. Lottos can go to zero very quickly, but they can also give you moves of 300 to 1500% very quickly as well. Hence the name lottos, all right? Again, just to be clear here, you're not gonna buy a lotto contract with your mortgage money. You're not gonna put money that you can't afford to lose into an option lotto, okay? So are you gonna buy the lottery with your mortgage? If the answer is no, then you shouldn't buy lotto options with big size either, okay? So that's in regards to the options and how quickly you guys can get into option lottos and lose money in options lottos as well as make money in option lottos. But this little crash course was to help you guys understand the basics of options, so now you can use that to gain some knowledge and use unusual whales to understand how the flow comes in so you can make educated decisions based on a call or a put and make profits. So let's get into unusual whales. So if you guys are day trading and if you want to get in and out quickly, one of the filters that I use and I have on my screen, I leave this flow chart open on the side of my monitor as I'm looking at the stock and looking at the sectors. I want these filters to be what I'm really looking at, okay? So on the filter section, I press reset, make sure everything is gone here. Premium range, I want above 20,000, okay? And that's simply all that I'm looking at in regards to me watching what flow is coming in, okay? So then I minimize this and I watch the flow as it pours in while the market's taking place. Now, as that's taking place, I also have other charts that I'm looking at, okay? So for example, one of the charts that I'm constantly keeping my eyes on is the SPY, and I suggest you guys do the same as well. Keep the SPY on your side chart, keep the QQQs on the side chart. That way, when you see, the market kind of selling off and you have big buyers kind of stepping up here, then you can understand that, they're expecting the move to go up here when they're pouring millions and millions into call options right here at this support level. They're buying SPY calls. Then sentiment's changing here and they're gonna try to push the market higher. Now, with that said, you're probably thinking, well, I'm not gonna trade SPY. Why would I be worried about that? Well, that's because the SPY is gonna be your go-to indicator to see, if other things are gonna move. If the SPY is gonna push forward, oftentimes, most other stocks are gonna move with it as long as they're following the SPY. There's times where there's relative weakness and relative strength, but that's for a whole nother video. So you can use what the flow that's pouring in here and kind of gauge where the momentum seems to be going. Oftentimes, when you don't have any ticker symbols being in the filter, you can see some big orders come in and actually spot, some indicators that, now they're buying Amazon. Then you can team that up with, hey, the SPY is sitting at support, they're buying Amazon calls, and they're expecting Amazon to go up. SPY is coming into support. It's starting to put some basing pattern here. All these millions of calls came into Amazon. Then you can look at your chart, identify a pattern, and then you can take calls or puts based on what your risk tolerance is. If you're choosing same week expiries, you're gonna wanna get in have your 20 to 30% stop loss that we discussed in the PowerPoints earlier. Get in, have your 20% risk, and ride the wave to the upside. If you have flow on your side, if you have flow on Amazon coming in, if you have the charts sitting at support, that's all you guys got to team up together in order to make the right decision. Now, another thing that I like to do is I like to open a new tab. All right, go to flow and go to filters, reset the filters again. I want to put this back on 20,000, but I want to come down here and I want to check opening orders. Minimize this. Now, what I do is in the mornings, I have the flow running as options are pouring in. I look at the flow and simultaneously I take a look at, what are the opening orders that are coming in. Sometimes I just like to look over here and see what companies or what whales are looking to open orders on. For example, right here at around, what is this? 340, I should say. Yeah, around right before close, 4.7 million in a bearish call came in on EXPE. All right, so this is what you got to take into consideration as well. These are opening orders. They're buy to open or sell to open, and it's going to give you another avenue to double check your work. Okay, guys. So again, make sure you have one tab with the flow open with no other filters other than 20,000. This way you see everything that's pouring in. Make sure you have your SPY and the QQQ chart, your intraday chart if you're day trading, up as well. This way, if it's pulling into support, you're seeing flow that's bullish come in on the SPY, and you're looking to trade a specific ticker, then you know that everything is kind of lining up and you can take a trade. All right, guys, I hope you found value in this video. If you did, please go ahead, like, comment, and share this video, retweet this video with everyone on your list. It did take me some time to put this video together, and I would appreciate it if you guys show some love by liking, commenting, and retweeting this all over your social media. All right, guys, for more videos, make sure you guys tune in, like, and subscribe as well. Thank you for watching.